Hello and welcome to Livewire's Buy, Hold, Sell. My name is Chris Conway. Small caps have roared back to life in recent months, outpacing their larger cap cousins and capturing the market's attention. But can the rally last, or is it running on fumes? To answer that question and a couple more, I'm joined by James Nguyen from Tyndall Asset Management and Shaun Weick from Wilson Asset Management. Gents, I'm going to start hot. It's the biggest question that we need to ask and answer. Can the rally in small caps continue? James, I'll come to you first.
My view, absolutely. Reason being that, even though small caps has outperformed large caps by 13% this year, if we wind back to 2021 when interest rates first went up, small caps has underperformed large caps materially. And so, they still underperform large caps by over 20% despite the outperformance this year. So I think there's still a long runway for small caps to go. And the second point is also that small caps are generally more leveraged to the economic cycle. And where we are in the cycle at the moment, I think the Australian economy is proving to be rather resilient. In addition, where we are from interest rates, yes, we've had a pretty hot CPI number. But that said, my view is that all that has done is push a further rate cut to the right rather than eradicate a rate cut. So I think the ingredients are there for the small cap rally to be sustained.
Shaun, do you echo those sentiments?
Yeah, I'd echo James's comments. Yeah, I mean, from our perspective, we think underlying earnings momentum is improving in the small cap space, and particularly is far more attractive, we think, versus the larger end of the market. What I'd also say is to generally, when animal spirits are lifting in the market and you're seeing risk appetite and sentiment improve, you will see liquidity flow down to smaller companies, and we're seeing really good signs of that, particularly over the last few months. So we think that provides a good catalyst to continue to sustain the outperformance. We're also seeing generally just capital markets activity improve in the smaller end of the market. Equity raisings, that are delivering earnings accretive acquisitions are being really well received. So we think there's some good signs out there that can see that the rally sustain. And finally, just say from a valuation point of view, like small caps are trading around 10% discount to the broader market. In good times, they can trade at 20 to 30% premium. So we think there is scope for expansion.
Pretty bullish points there, gents, but we'll take the other side of the equation now. So what could derail the momentum? Shaun, I'll stay with you.
Yeah, for us, it's really just watching, where interest rates go directionally from here. And clearly there's quite a strong focus around inflation here domestically, and also in the US. But, our general view from here is, rates may be on hold for a period of time before moving lower again in 2026. And, we think that backdrop's still conducive for small caps, particularly with, improving earnings momentum. So that's what we're looking out for though.
Yeah. James, what about you? What do you think could derail the momentum?
As a starting point, I think valuations really kill a bull market. Generally, it's an exogenous shock that will put an end to the bull market. And by their very nature, exogenous shocks are pretty hard to predict. That said, I think the probably most likelihood, if we do get a shock, is probably consumer-led recession from the US, not Australia. So I recently came back from the US, spoke to a lot of retailers, spoke to a lot of QSRs or restaurant operators, and spoke to a lot of debt buyers, and consensus is that the US is slowing and probably at the lower end. I think the most insightful meeting was a meeting with Chipotle, where the last 6 months has seen a slowdown in households with a 40,000 income or lower really seek value. And what they've seen in the last couple of months is that households up to 100,000 have started to seek value and started to pull their heads in. So, whether that's a canary in the coal mine, I don't know. And it's definitely not our base case that the US will enter a deep recession, but there are signs there that the US economy is slowing.
Yeah. We'll shift gears now and talk to the gents about the sectors they are finding appealing amid the current small cap rally. James, I'll stay with you. Where are the hot areas at the moment?
Yeah, so in the last couple of months, for us, the thematic that we're sort of attracted to is the resilience of the Australian consumer. We've been running sort of a material underweight in the Australian consumer for the past 12 months, but we've really closed that gap. Yes, a lot of the retailers have run pretty hard. I never thought I'd be sitting here saying that I own a furniture retailer trading on nearly 30 times earnings in Nick Scali, and I didn't think I'd own a car dealership trading on nearly 30 times earnings on AP Eagers. But the Australian consumer seems to be pretty resilient, and I think if you dig a bit deeper, there are plenty of other opportunities within the consumer discretionary that are trading a lot cheaper, like Baby Bunting or a Peter Warren, where the turnaround is only just beginning.
Yeah. Shaun, what about you? Areas, sectors that you're finding appealing at the moment?
Yeah, probably a couple of key themes for us. I'd echo James's comments in terms of the interest rate sensitive names that are domestically focus continue to look attractive to us. So, Yeah, the auto dealers, I'd highlight Auto Sports Group. Now AP Eagers is about to exit and go into the 100 index. We still own the stock. They've got a great opportunity in Canada, but we think investors will gravitate, now towards the smaller end. Motorcycle Holdings fits into that bucket as well. We like the land lease community space. So GemLife, which recently listed, back in May. Genia, we think, looks good. Cedar Woods, their recent update highlighted, pre-sales visibility really out into 2027. So the housing market's clearly, running with some good momentum. Another, area we continue to like is the mining and industrial services space. Clearly there's strong tailwinds there from, commodity prices. Infrastructure spend is continuing to remain, strong. Defence is obviously an area that's been highlighted more recently too. So, we think the likes of a Tasmea, SRG, towards the lower end, a Genus Plus, Visan, a little company called Mayfield Group, we think's got, really good momentum in that space. And then finally, just the technology sector in general. We think there's a great ecosystem of companies here in Australia at the moment. Life360 we've owned for a long time. We think the market's just, materially underestimating the pet and advertising opportunity. And then, some other selective plays like Megaport for exposure to the AI infrastructure theme, and then also Catapult within that sports wearable space. We just think the market's missing, the ARR acceleration. And I suppose it could play out with the Impact acquisition. So you got to be selective and be active. But yeah, we think the market still looks like it's throwing out some good opportunities across those areas.
The gents have both mentioned some stocks there, but I'm going to ask them to sharpen their focus now and ask them about the small cap that has them most excited, and equally the one that is keeping them up at night. So Shaun, I'll stay with you. What's one that's got you most excited?
Yeah, I mentioned one of them, which is GemLife. So this is a pure play builder, developer, owner, operator of land lease communities on the eastern seaboard. So, management there, we think are among the best listed on the ASX within the small cap space, led by Adrian Puldich and also the CFO, Ashmole Thrakrat. So what we'd say from here is, you fundamentally leverage to, what is a structural shortage in housing supply. Clearly there's good tailwinds there in terms of, downsizing and people seeking more affordable housing. They delivered their, inaugural prospectus result at the half year. Earnings are tracking sort of 8% ahead of prospectus forecast. We think they can deliver that, at least again when it rolls around to the full year. And then, you're effectively looking at ASX 300 index inclusion in March, which, is becoming an increasingly powerful tailwind across the small cap space. So yeah, we think that one still sets up, really attractive. And, the land bank that they've got essentially funds them to 4x the size of their business. So we think long term there's a lot of upside in that one.
Yep. So GemLife for you, Shaun. James, what's one that's got you excited?
Yeah. It's an interesting one in that we've been reducing our gold exposure. So we've been running 15-16% and gold at $4,000 an ounce. The contrarian me says that you should be taking profits. So we've been selling gold and so now it's about 11-12% of our portfolio. But within that, one stock that we're very convicted in, a company called Vault Resources. And the reason being sort of threefold. One is that its balance sheet is immaculate. The second is basically the free cash flow growth, going from 9% to 19%. And what really excites me about the free cash flow growth is, generally speaking, whenever you see a resource company with that type of free cash flow growth, it's because they're in development phase or they're in ramp-up phase and you're taking on a lot of operational risk. In the case of Vault, that free cash flow growth is all because of the hedges rolling off. And so all you'll have to do is be patient, wait 18 months and cash flow more than doubles. And the third thing I'm drawn to Vault is that they're going through capital management. And what I mean by that is a lot of resource companies, when they generate free cash flow, we tend to get excited, but we shouldn't because you never get your hands on that cash flow. Reason being that mine's finite life. Executives have an incentive to essentially acquire more assets, to one, grow their assets, or two, to keep their jobs. In the case of Vault, the free cash flow they're generating, they've got a 10% buyback, and my view is that shareholder return will be a recurring theme as cash flow continues to grow.
Two strong picks there. Now the one that's robbing you of sleep, James, what's keeping you up at night?
The one that I sort of stay awake at night is a company called Web Group. And even though it's the smallest active position in my portfolio, it's one that I worry about. The reason being that, it's in the last 12 months, it's been through a pretty rough patch and the management has really disappointed on margin revenue compression. And it's really been driven by own goals. In defence to the CEO, John Gusick, he's looked to address that and he's made personnel changes. Well, the reason why it keeps me awake is Threefold. First is that the business itself is very cyclical. Bottom line is travel is consumer discretionary. The second is that travel is also exposed to geopolitical risk. And we see during the Ukraine issues with Russia that it impacts businesses like Web Group. And the third is, given the missteps they've had, I genuinely don't know how much goodwill John has with the investment community anymore. So I think any further missteps will be doubly punished. That said, the business is a capital light business. It trades on 15 times earnings and the medium term earnings growth is 15%. So I don't know how much is baked into the numbers. I think a lot of that pessimism is captured in the numbers, but I still stay awake a lot over that name.
Shaun, what about you? What's one that's keeping you up a bit?
Oh, well, I've got a 14-month-old baby, so that's keeping me up a fair bit.
Yep.
But yeah, from a stock perspective, it's Iress. There's 5 bidders in the data room. The press have been, reporting that of recent times, and the company have come out and confirmed it. I guess it's keeping me up because we've been here before. Back in 2021, they had a bid from EQT at $15.90. Stock's trading around $9 at the moment. So it probably would have been wise to have hit that back then. So yeah, we think obviously there's a decent chance that the business will get taken out given that there's competitive tension in the data room. But for us, it's probably just trying to work out, what level of control premium sort of being built into the share price at the moment. And if that does fall through, sort of, what's the right level to be playing the stock. But the incoming CEO, Andrew Russell, we rate very highly. He done an extremely good job at Bravura in terms of right-sizing the cost base and driving the free cash flow and improving the top line. We think the playbook's the same here. So it's not all doom and gloom if the bid does fall through. We think there still really is a good operational turnaround opportunity here. But yeah, it's one that one that's definitely keeping me up here and there.
I'd add that we actually own Iress as well, and it probably would have been my top pick, keeping me up awake at night. But Andrew Russell there, I think, gives us a bit of comfort.
Yeah.
There you have it, ladies and gentlemen. A couple for the watch list and a couple to watch even closer. If you enjoyed this episode, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.